We've been hearing about this all over the internet. Nancy Pelosi's trades have made her millions in the past 2 years. Her Amazon trade alone pocketed her $6 million. She invested in Amazon right before the government forced physical retail stores to shut down. While her salary is just under $200K per year, her net worth is just under $200 million. And by the way, she's not just an outlier. And it's not even just congressmen or politicians. Many corporate insiders also make a lot more money from their trades than from their salary. But isn't this illegal? Why are the people in these stories not in jail yet? See, classically, we associate the term of insider trading with illegal insider trading activity. But there are insider trades that are very illegal as well. For example, the officers, the employees, and the directors of a corporate publicly traded company can trade shares of their own company too. So what's the difference between a legal insider trade and an illegal insider trade? Well, to answer that question, we should look at what makes illegal insider trading illegal in the first place. Why was it made illegal? Insider trading is illegal because it undermines the confidence of the average investor in the fairness of the stock market. But what does this really mean? Why would it bother us that a couple of CEOs or corporate insiders would bank in on their good quarter that they worked for just because we feel that it's unfair? Why would we feel that it's unfair? Well, let's pretend for a moment that we live in a world where insider trading is legal. So there are a select few individuals who have access to that insider information that can make a stock go up once it goes public. And these people now can cash in on this information. So what happens? These people will widely beat the market. And for the sake of this mental exercise, will widely beat all the other hedge funds and all the other investment methods. So as a hedge fund manager, why would you bother to pay a pool of highly skilled and highly paid analysts to try and decipher what the market is going to do next, when you could just pay those insiders to give you that information? You could just make friends with those that are in Congress or those that are inside corporations, wait for their tips, and then when they tip you in, you just invest. Voila. And if you're an investor, why would you go and put your money with a hedge fund that doesn't have access to these insiders when you know that the ones that has access will make a lot more return? So now what just happened? Now the stock market is no longer a fair game of whoever has the best ability to predict what's going to happen in the future. It's a game of relations. It's a game of network. You have to either be the insider of a successful company, or you have to be friends or know people who know people. So good information becomes scarce, and while a small group of well-connected people will make extravagant returns, what will happen is that most people, they'll either be okay with making average returns on index funds, or they'll just move their money elsewhere. And there are a lot of ways to make returns on your money that are way above the average stock market index fund returns. You have real estate, private companies, starting your own business, being in private equity. There are many ways to beat a market, especially an unfair one. So if you're the SEC, you obviously don't want this to happen. You want as much money as you want, and especially we know that there is so much money that's in the stock market to beat the average. Not just to beat the average, but to beat the average of the market. So if you're the SEC and you lose that money, you're in a world of pain. And this is why the SEC bans insider trading under rules 10b-5.1 and 10b-5.2. There are both rules to prevent people who have access to this kind of information to trade on it without disclosing their trades. But the first one concerns those who are insiders, while the second one concerns those who have access to this information without necessarily being an insider. Okay, but here's the thing. On one side, you're telling insiders to not trade based on their knowledge because it undermines the average investor's trust in the stock market. But on the other side, it's bound to happen. The returns that you could make from insider trading are huge. And honestly, you'd be kind of dumb to not try and take advantage of that. The SEC obviously know this. So they struck a happy medium. They figured that, hey, since all we're trying to do is avoid a breach of trust, all we have to do is make those insiders disclose their trades. And now their trades are public, so you can tell when an insider is buying, so you could buy as well. So if you think the best way to beat the market is just to follow the insiders because they know they have all the information, then you could just do that. No matter your network, no matter who you are, as long as you have access to US stocks, you could just follow these insiders. And this information is available publicly. So let's say, for example, if you're Nancy Pelosi or any other congressman or representative, you have to file a periodic transaction report where you disclose all your trades, whether they're stock buys or their stock options. And if you're an insider inside a company, you have to disclose a Form 4 where you say, okay, about this stock, about these options, blah, blah, blah. And now these insider trades are available to everybody, and the game is somewhat fair again. For example, let's say that you've witnessed Nancy Pelosi's massive gains and you want a piece of that. All you have to do is go to clerk.house.gov, go to the disclosure section, find the search function, type in Pelosi, and voila. All of her reports are available to you. You can even bookmark it for further visits. Let's say that you visit frequently and you notice on the 21st of January that she bought in a couple of options of Tesla, etc. Trusting the Pelosi cut, you follow her trade, and lo and behold, 4 days later, Joe Biden announces that all future government vehicles are going to be electric. So you invested before, you followed an insider, the bullish news come after. You made yourself a lot of money, right? Right? Is it that easy? Can you just beat the market by following insider trades? Okay, so to make sure that insider trading is actually profitable, we'll look over a couple of studies that went over insider trades and compare them to the market averages to see where they place themselves. Just as a disclosure, this has to be taken with a grain of salt. I didn't thoroughly check the methods of each of these studies, but the universities seem reputable, so I just thought I'd include them here, but I wanted to tell you, take them with a grain of salt. So in 1986, University of Michigan professor Nejat Seyhoun found abnormal returns of 4.3% for the first 300 days for firms with more insider purchases than sales, and minus 2.2% in the same period for firms with more insider sales than purchases. In 2003, Harvard University's Leslie A. Jane and Richard Zeckhauser and Yale University's Andrew Metrick calculated insider actual returns for their purchases and sales. They found that insider sales are not profitable, but insider purchases are extremely so. In raw returns only, insider purchases beat the market by an average of 11% per year. So we have academic studies telling us that on average, insider trading is profitable. And we have empirical evidence of congresspeople and insiders, corporate insiders, making a lot more money from their stock options and from their buys and sells than from their own salary. But before dropping all the other strategies for this one, we should still explore how things can go wrong if we decide to follow these insider trades. And you guessed it, no strategy is foolproof. Even this strategy has a couple of shortcomings that can make you lose money. Here are 5 challenges that come with imitating insider transactions. Insiders can be contrarian traders. Not only do you have to be able to stomach such an act of blind faith, you also have to adapt the trade according to your own situation. Because things can turn ugly and you might get margin call before the piece of bullish news hits and the stock option goes up. Second reason, insiders sometimes don't buy for short-term profits. Sometimes they don't even buy for profit at all. From time to time, they can make these buys that are more of a PR move than anything else. Because they know that their trades are under scrutiny. They know that if they trade, they're going to have to file a Form 4 and people are going to go through that form and they will see that this insider bought this much stock even though it's going down. So that means there's some bullish news coming up and so we have to buy the stock too. But it's all just a PR move. The third challenge is the delay between when the trade was performed and when it was disclosed either on a Form 4 or a PTR. Insiders filling out a Form 3, 4, or 5 can take up to 48 hours to disclose it. And when it comes to PTRs for Congress people, that can take up to a month. Nancy Pelosi regularly discloses her PTR a month after the trades. And if we look at the Tesla case, she bought at this level right here, and then when she disclosed the trade, the stock already went up considerably. So she already made a lot of money before the reports even hit. And now I know the expiration date of the stock option is not exactly short term, but sometimes the profits can be made before the report is disclosed. Also, speaking of delays, the market responds very quickly to insider buys. There are multiple firms that specialize in insider trading and in following insider buys and just blindly buying when insiders buy. Because as the studies above have shown, you can beat the market by doing this strategy. The word gets out fast, you have to be quick on your feet. There are many resources to attract these insider trades. And yet, if you don't have blind faith in this strategy or in the person that's doing this insider buying, you have to still be patient enough to consult fundamentals before going blindly on the company. And fifth and final challenge is that there is no guarantee that this strategy of following insider buys, even though on average they're profitable, there's no guarantee that they're going to be profitable each and every year. And in fact, according to InsiderMonkey.com, this happened right between 1996 and 1999, where insiders underperformed the S&P 500 by 38% over the 3 years. That's nearly 13% each year. So following insider trades is not a bulletproof strategy. On average, it will beat the market, but in some cases, it won't for consecutive years. So personally, I can see 2 ways to profit from this knowledge. Obviously, this is not financial advice. I don't have the qualifications for that. But personally, I'll still be keeping an eye out on Pelosi and some other of her friends that made a lot of money outside of their salary. I'm also going to be following insider trades from tech CEOs that I trust. There are many resources to track insider buying because all of them have to file a Form 4 or a PTR depending on their position. So if you go on Google and type in insider buying Form 4, you'll find the official SEC websites where all the Form 4s submitted are put online so that they can become public domain. However, these tend to be hard to read, so there are a lot of websites that specialize in analyzing these informations and making them easier to read for the public. So you have websites like insidermonkey.com, insidertracking.com, finviz.com/insidertrading, I think. I'm gonna leave all these links in the description if you want to check them out. I also found a YouTube video of a guy that made a Python program to track Nancy Pelosi's trades real time as soon as they get published on the clerk.house.gov website. I'm gonna leave that in the description too. Otherwise, in general and personally, I think I'll be sticking to value investing instead. The returns I have witnessed myself and I've seen other people around me get are more interesting than following insiders and trying to have this act of faith, putting this act of faith on them and hoping that somehow you'll perform the market by following the right people. It's risky, it involves a lot of delegation on people you don't know personally, so for me, it's not going to be okay. I still prefer to go personally over the fundamentals and check the stock and study it and see why would it go up instead of just blindly betting on some bullish news that's going to come up because this insider bought. But anyway, I'll keep you updated if I change my mind. I usually do. But until then, see you next time.